everyone, my name is Nomhle and welcome to our Financial Markets Literacy channel. So today we'll be covering 5 topics as a continuation to what we have started, which is educating one another on financial markets and how we can basically get started. So the 5 topics that we'll be covering today are market structure and trading sessions, currency pairs, trading terms, trading calculators, and the different order types that are available out there. Let's go into what is market structure, all right? So the most basic definition that we'll explain is that market structure is a basic support and resistance levels on charts, swing highs and swing lows. And that's that. And obviously there are different types of market structures that one can look at. And the 3 types of market structures are a bull trend, a bear trend, and a sideways trend. So a bull trend is a trend going upward. Best way to think of it or to remember is think of how a bull would fight. A bull would probably hit you upwards, right, with its horns, so you fly up. So that's what you would call a bull market or a bullish market or a bull trend. And then you get a bear trend, which is how a bear would fight is that it would hit you to the ground, and that's what you would call a bear market. Is when a market is declining or is going down, that is considered a bear market or a bear trend or a bearish market. And then you get your sideways trend. Obviously that it's not going up or down, it's just going, sideways, as the term says it itself. So those are the 3 different market structures that we have. There are also different trading sessions that are available, and these are some of the sessions that you need to take into consideration as they are part of the major market movers. Right, so the first one that we have is called the Pacific session, which covers Sydney, and all the times that we'll be making mention of right now are Eastern European time, and it's called EET, right? Eastern European time. So with the Pacific session, you're looking at Sydney, and that opens at about 12 a.m. in the morning and closes at about 9 a.m. in the morning. And then you have Asian session, which is in Tokyo, that opens at around about between 2 and 3 a.m. and it closes between 11 a.m. and 12 p.m. And then you have the European session, which is the London session, that opens around about 10 a.m. and it closes at about 7 p.m. And then last but not least, you have the American session that opens around about, the American session is also known as the New York session, that opens at about between 3 and 4 p.m. and closes at about between 12 a.m. and 1 a.m. So you need to put these into consideration each and every single time you are trading, because the different time zones or the different times in which these markets open do impact how the markets also move. You'll also check that if you're watching closely, there tends to be a whole lot more volatility around the times when these sessions open and around the times when these sessions close. All right, so outside of that, we're also going to look into the different currency pairs that you can have a look into. And these are some of the major currency pairs that you can consider looking into. And these are also impacted and influenced by the different trading sessions or different trading times when the markets are opening and closing. So for example, the euro dollar is affected by the European session, and it's also affected by the American session, which is the London session, and also the New York session. So you would want to look into these pairs. For example, if if you're looking at the Euro USD, another thing I also want you to take into consideration is that it always comes, when you're looking at currencies, they always come in pairs. And these pairs are called, the first one is called, or the one that is in the front will always be called the base currency, and the second one will be called the quote currency. So when you're looking at the euro dollar, the euro in this instance would be the base currency and the dollar would be the quote currency. All right, so here's a couple of currency pairs you can look into. The first one, in no particular order, is you get the Euro USD, GBP USD, USD JPY, AUD USD, USD CHF, USD CAD, NZD USD, and Euro GBP. So those are some of the major currency pairs you can consider looking into when you are looking at trading. Now that we know the different types of currency pairs, especially the major currency pairs, what else can we look into? We can also look into the different trading terms. The trading terms is something that we'll be covering or try to cover as we go along, because there are so many trading terms that are available out there. So we'll try and cover bit by bit so that it's not information overload. So today's term that we'll be covering is called lot or lot sizes. So what is a lot? A lot is a unit measuring a transaction amount. Just like you would measure distance by kilometers and let's say water by liters and your weight by kilograms, you also measure the units of trades by lot sizes. So when you're looking at a standard lot, we have about 4 different types of lot sizes. We get the standard lot, which is 100,000 units, and then we get the mini lot, which is 10,000 units. A micro lot is 1,000 units, and a nano lot is 100 units. So if you were to be placing a trade, either be it on oil, gold, or the euro dollar or currency pairs, these are the types of lot sizes that you would consider looking into before placing your trade. Some of the most important things to consider is that when you're placing a lot size, because of your account or your equity, it will allow you to place a certain lot size based on the amount of money that you have in your account. So the bigger the account size, obviously the more lot sizes it will allow you to take. The smaller the account size, and then you can obviously take a much smaller lot size as well. So that's also something that you can consider when you're looking into why the different lot sizes exist, and there is no universal lot size. It's so that it can cater to different account sizes as well. The different trading calculators that you can take into consideration or that you can consider. The first one is called the risk percentage calculator. So there is an option for you to calculate how much risk you'll be taking before you get into a trade. So rather than you having to get into the trade blindly, it's always best to plan your trades well in advance so that you know exactly how much you're risking on the market and you don't want any surprises. There's also an option where you can calculate your margin. Remember, we did cover what margin is on our previous video. So if you'd like to look out for that, please check out the previous videos so that you can know what margin is. So which is a deposit, right? So if you wanted to calculate how much your deposit or how much your margin is going to be, there's also an option where you can calculate all of that. This leads us to our next topic, or rather to our next point, which is the different order types that are available for you. So we have 4 different order types that we'll be covering. The first one is called buy stop. A buy stop is to open a long position at the price higher than the current price. So let's say, for example, the current price is this hand, right? And you want to buy at a higher price than what it's currently trading at. I know for some it might sound like, that doesn't make sense, but the reason why you would do that, it would be because of some analysis that you would have had done, on your trades to say that, okay, I can see the current market price that it keeps on hitting it, but it doesn't go beyond that price. So I'm scared that if I get into this price, it might go the opposite direction. But based on the analysis that I've done, mostly technical analysis that I've done, it's anticipating that if I buy at a higher price, it has much higher probability of continuing in an upward trend. So I would like to buy at a much higher price than it is currently trading at right now, because that is the analysis that my technical indicators are currently giving me. So that is one of the reasons why you would set up a buy stop. And then you have a sell stop. A sell stop is to open a short position at the price lower than the current price. So it's exactly as the buy stop, but now it's in the opposite direction, where you're saying that you would like to open a short position. This is the current market price, but you want to open at a lower price because you're anticipating that it's going to go, or it's going to continue going down from that lower price, right? So this is after you have done your technical analysis or any other form of analysis that would give you that indication to say this is the price that you should enter at, so that if it does continue down, at least you have higher probabilities, quote unquote, higher probabilities of you being in a profitable trade. And then we have buy limit. So a buy limit is to open a long position at the price lower than the current price. So this is the current price, and you want to open up a position at a lower price compared to where it's trading at. And some of the reasons why you would want to do that is that you want to cover more pips, right? Let's say this is the current price. You might find it just slightly a bit expensive in order for you to reach your target or your goal in terms of your trade. So now you'd want to get in at a much lower price, so that if it does continue in your direction, at least you have a higher profit return or ratio compared to if you were to enter at the current market price. So hence you would go and buy at a much lower price, so that you're rather more profitable, because if you get in at that current market price and this is your take profit, it would be different compared to getting in at a lower price and then taking profit at the very same. So this is someone who says that I'd rather buy at 10 and sell at 15 rather than buying at 12 and selling at 15. So that would be an example of a buy limit. All right, so a sell limit is the total opposite, same order, but in the different direction, to say that I would like to open a short position at a much higher price, right, than the current price. So if I'm selling from this price, I'm anticipating that at least I will cover more pips or more profits, and then I'll take profit with a much wider gap compared to if I enter into that current price, where even if it does go in my favor, my profitability would be much lesser compared to if I had bought at a much higher price than what it is currently trading at. That is it for today, and what we'll be covering next week is market analysis. So we're looking into the different types of analysis that there is for you to do before you get into the market, before it gets to a point where you actually buy or sell on the platform. You would have to do your analysis, so that's what we'll be touching base on, and we'll continue from there onwards. So please don't forget to like, comment, subscribe on this channel, so that we can reach a much broader and much larger audience, and let us engage more on financial markets, and let us share the word as well to people that you might find or might find this useful. And yeah, let me know what other topics you would like for us to cover, and I'll be more than happy to look into that. So yeah, take care, have a blessed week, and I will see you next week. Bye.